Hello and welcome to another ACY Securities Aussie Open update. Now in today's video I am doing it without slides. We are sort of getting ready for some other segments that are going to be on AusBiz a little bit later today. However, I thought it was worthwhile to update you all on what's really gone on in the overnight session. The first things that we need to have a look at and know about is that it is the sixth straight session in a row that we've seen all-time highs appearing on the S&P 500 and on the NASDAQ. So again, we continually are getting these all-time highs, and it does make a little bit of an interesting point for us to really look at in the future. How hard and when do you look for the top? The answer to that is a little bit difficult. I prefer not to look for the top or the bottom, just to keep riding the wave with it. Now, realistically, what are we looking at in terms of circumstances around the world when it comes to this? Well, we have slowing infection numbers, we've got all-time highs occurring, we have stimulus on the way out, we have vaccines happening, and we're starting to get some form of bond value coming back with yields starting to tick up. So what is there really not to actually like? Now, what we've seen so far from what we've heard on stimulus out of the US between Biden and Janet Yellen over the last couple of days, they seemingly are committed to a very big spending package, which is going to be positive for stocks all the way around. With those yields ticking up as well, bond investors are going to be quite happy with the results that we're going to be seeing, and they're likely going to be hoping for more to come in the sooner. People are feeling confident overall, not just about the idea of what's happening with the vaccine, but they have safer and more confident expectations for the economy and a recovery to come on track next. Right this second, markets are experiencing a little bit of a sweet spot. We've got the pandemic recovery sort of side of things in action, and that's giving us a projection for boosted earnings towards the end of the year. Now, it's important to remember that even though we've seen sell-off in benchmark bonds, that it does remind us that it is still just a sweet spot right now. Growing inflation concerns are starting to tick up. We are seeing people being concerned about the idea of inflation running maybe too hot or at least too quickly for us to be able to manage it. Long duration growth and obviously those expensive and highly profitable stocks are probably going to be the ones with the most risk at this stage. Now, if this feeling of pressure continues to grow in investors about the idea of inflation, expect to see that we see cyclicals and those banking stocks and of course those industrial stocks starting to rally up. What we like to think of as the inflation stocks are very much overlapped with what we see in cyclicals, so that might be a good point to look for. Now, in terms of stress points, if we do start seeing inflation move beyond 2% or even getting close to 1.75%, those yields on the S&P 500 in terms of dividends are going to be something to keep an eye on. If it goes above 1.75%, or at this point in time, more than 60% of stocks on the S&P 500 offer a better dividend return than what 10-year Treasury yields do. But if 10-year Treasury yields move to the 1.75% and above, then all of a sudden we're seeing closer to 44%, and eventually the higher that number goes, the less attractive the valuation on dividends is likely to be. Now, it's still a risk to consider, but currently stocks, as I said a couple of times already, are in a sweet spot. We have improving expectations, rising earnings, and of course, investor sentiment is all picking up as well. So it's all keeping it very, very optimistic. Now, something else for us to really be looking at is oil pricing. In the overnight session, we've seen it reach $60 for Brent and for WTI, pretty close behind. Now, what do we make of all of that side of things when we think about oil prices, particularly after the moves we've seen last year? For me, oil last year was a little bit of an interesting scenario. We have a known price point where Russia doesn't like the idea of the US starting to manufacture or produce further oil. So what price is that? Roughly about the $60 mark. So right now I am interested in seeing what happens, not so much in what we might see in the EIA report later this week, but at the ex-OPEC meeting, what they might be deciding to do, particularly with the interesting relationship between Saudi Arabia, Russia, and of course the US. And the reason behind why all this goes on is probably a little bit trivial, but at the end of the day, they want to keep a greater share of the oil market. Anything above $60 means that we do start seeing an increase in fracking production. So from there, looking further on, as a recap, we've seen what's going on with oil. Obviously, I'm quite interested in that side of how things go, but there is something that is a little bit interesting here. If you look at oil-based stocks, they've been lagging behind the S&P 500 for more than 6 years, and right now are lagging by more than 50% on its general returns. So I think that there is likely some pretty good opportunities to be found now that oil is back at $60 per barrel in oil-based stocks. So keep an eye on some of those moving forward. Of course, don't forget this week is earnings week. We do have a number of other companies that are going to be reporting. We'll also be hearing from Cisco, we'll be hearing from Twitter, Corsair, Systems, Honda, and a few others along the way. And we'll also be hearing from a couple of central banks, and there is expected to be action being talked around on the EIA oil drop. So keep an eye on that market for today, see what you might find. That's all I have for today's morning update, but please feel free to get in contact with me via any of my social media channels, and don't forget to like and subscribe to this video so you can get more great content from me and ACY Securities in the future. Have a great trading day ahead.